Disclaimer.
Today is January 14th, 2026, and the paper silver market has just officially ceased to exist. While the stock exchange is drawing you the number 92, reality is hitting you in the face. Silver in hand today costs $120, and the worst thing is that it is impossible to buy it. You yourself write about it in the comments. Dealers are canceling orders, shipments are frozen, and the largest online stores have simply turned off the buy buttons. This is not just a shortage, this is the great delivery failure. The great failure in deliveries that we have been warning about for years. Even the banking giants are panicking. Citibank has just urgently raised its forecast for gold to $5,000 because they know the vaults are empty. The world is trying to get out of paper wrappers and into the real metal at the same time, and the door has closed. Today I will show you evidence that COMEX is on the verge of a complete shutdown and tell you what to do if your silver has not yet been shipped. Watch until the end. The time for paper illusions is over. Picture yourself walking into a coin shop in Tokyo this week with cash in hand, ready to buy a 1-ounce silver bar. The dealer quotes you $130. You check your phone, the COMEX screen shows $92 for silver. Same metal, same day, but you're staring at a 40% premium to buy the actual physical bar in your hands. This isn't a quirk of foreign markets or a temporary glitch. This is the sound of a market breaking in real time. What if I told you this gap isn't just happening in Japan? Dealers in Dubai are charging similar premiums. Buyers in India are scrambling for whatever physical silver they can find. Meanwhile, our American futures exchanges keep displaying that $92 number as if nothing unusual is happening. The paper price and the physical price have officially divorced, and the implications should make every American investor pay very close attention to what's unfolding right now. Here's what you need to understand about how silver trades in our financial system. Most people assume that when they see the silver price on their brokerage screen, that's what silver actually costs. But there are really two separate markets operating simultaneously. There's the paper market, the futures contracts, the ETFs, the derivatives trading on exchanges like COMEX in New York. Then there's the physical market, the actual bars and coins sitting in vaults, changing hands between refineries, industrial users, and investors who want metal they can touch. For decades, these two markets moved together because traders trusted they could always convert paper claims into physical metal. That trust is now evaporating before our eyes. The data coming out of COMEX tells a story that Wall Street doesn't want you to see. According to exchange records, registered silver inventories, the metal actually available for delivery against futures contracts, have collapsed 70% since 2020. We've gone from over 400 million ounces sitting in those warehouses down to just 127 million ounces today. Think about that for a moment. In just 5 years, 70% of the deliverable silver vanished from the system while paper contracts kept multiplying. The pool is draining while more people are holding tickets to swim. Now here's where this becomes urgent for every American watching their retirement accounts. January is typically a quiet month for silver deliveries on COMEX. It's not one of the major contract months when big players usually stand for delivery. But something extraordinary happened in the first week of January 2026. Delivery demands hit record highs for what should have been a sleepy period. On January 7th alone, JP Chase had to deliver 8.1 million ounces. Not just a portion, 99% of all silver delivered that day came from one bank. When you see a single institution forced to empty its vaults during what should be a minor delivery period, that's not normal market activity. That's stress fracturing the system in ways that should concern anyone with exposure to precious metals markets. Let me paint you a picture of what's actually happening inside these exchanges. Have you ever wondered how many paper claims exist for each physical ounce of silver? According to current COMEX data, the ratio stands at 356 to 1. For every single ounce of real metal sitting in those registered vaults, there are 356 paper contracts claiming ownership. Imagine a parking garage with one parking space but 356 drivers holding tickets that say they have the right to park there. The system only works as long as most drivers never actually show up to claim their spot. But what happens when they start arriving all at once? This is where the story gets even more revealing about the desperation building in our financial system. The Chicago Mercantile Exchange, which oversees COMEX, made a dramatic move in the second week of January. They raised margin requirements on silver futures by 47% in a single week. Your cost to hold a contract just jumped to $32,500. Now, exchanges don't randomly hike margins like that when everything is fine. This is the classic kill switch banks deploy when they are trapped on the wrong side of a trade. By forcing traders to put up nearly 50% more cash overnight, they're trying to shake people out of their positions. It's a desperate move to reduce the number of contracts that might demand physical delivery. Think about what this means for your own investment portfolio. If you own shares in a silver ETF or hold paper claims through your brokerage account, you're betting that when you want to convert those claims into actual metal, Someone will be there to deliver it. But the hard data shows that system is under unprecedented strain right now. The premiums we're seeing in Japan and the UAE aren't random price spikes. They're the market screaming that physical metal has become scarce while paper promises remain abundant beyond belief. The divergence between paper and physical pricing accelerated dramatically after January 1st, according to trading data from multiple international markets. Something fundamental changed in the first week of this year. While COMEX screens continued displaying business-as-usual prices around $90, physical buyers started paying premiums that would have been unthinkable just months ago. When you see a 40% gap open up between what paper traders are paying and what physical buyers must pay, you're watching market structure disintegrate in slow motion. Here's a question every American with retirement savings should be asking. If silver is really trading at $92 on our futures exchanges, why would anyone pay $130 for the same metal in Tokyo? The answer reveals something fundamental about what we're witnessing. Those buyers in Japan aren't stupid. They're not overpaying out of ignorance. They're paying that premium because they know something critical. Paper claims may settle in cash when delivery day arrives, but physical bars in their possession can never be forcibly converted back into digital promises. They're buying certainty in an increasingly uncertain system where the rules seem to change overnight. The mechanism creating this crisis has been building for years, hidden beneath the calm surface of commodity markets most Americans never think about. Banks have written more paper claims against silver than physical metal exists to back them. They assumed that as long as most contract holders accepted cash settlements or rolled their positions forward, the discrepancy wouldn't matter. They assumed wrong. Now we're entering a phase where the mathematical reality of 356 paper claims per physical ounce is about to collide with surging delivery demands and a vault inventory that has already been reduced to its lowest levels in modern history. JP Morgan's actions in early January tell you everything about which way the smart money is betting. This isn't a bank panicking or making mistakes. This is strategic positioning by an institution that understands exactly what's coming. When the same bank that has dominated silver trading for decades suddenly starts delivering massive quantities during a traditionally quiet month, they're sending a signal to anyone paying attention. They're getting physical metal into the hands of clients who understand what happens next. They're choosing which relationships to protect when the music stops and there aren't enough chairs. The January data also revealed something else that should concern every investor watching commodity markets. Open interest, the total number of outstanding futures contracts, remains elevated even as registered inventory continues to drain. More tickets are being issued for the same shrinking pool of metal. This isn't sustainable mathematics. The numbers don't work. At some point very soon, the exchange faces a choice. Deliver physical metal that doesn't exist or force paper holders into cash settlement. Either outcome breaks the paper market's credibility permanently. What makes this particularly dangerous for American investors is how deeply silver is embedded in our financial infrastructure. It's not just a precious metal or an investment vehicle sitting in portfolios. Silver is a critical industrial commodity used in everything from electronics manufacturing to solar panel production. When the pricing mechanism breaks, when paper and physical markets diverge by 40%, it doesn't just affect traders playing commodity futures. It creates uncertainty that ripples through supply chains, disrupts industrial planning, and ultimately impacts the real economy where regular Americans work and invest their savings. The margin hike from CME wasn't just a technical adjustment to manage risk. It was an admission that volatility has reached levels the exchange views as dangerous to the entire system. When margin requirements jump 47% in 1 week, they're telling you the risk parameters have fundamentally changed. They're also trying to reduce the number of contracts that might stand for delivery in coming months. Every trader they shake out with higher margin requirements is one less person who might show up demanding physical metal that may not exist in the quantities promised. So here we are in mid-January 2026, watching a market structure that has functioned for decades begin to crack under the weight of its own contradictions. Physical buyers in Tokyo and Dubai are paying premiums that signal extreme scarcity. COMEX vaults have lost 70% of their registered inventory while paper contracts multiplied. A single bank delivered 99% of metal on a day when deliveries should have been quiet. Margin requirements just spiked to levels designed to force traders out. And beneath it all, 356 paper claims are competing for every physical ounce. The divergence between paper promises and physical reality isn't a temporary aberration that will correct itself. It's the inevitable outcome of a system that issued too many tickets for too few parking spaces. The question now isn't whether this breaks. The question is when and what happens to everyone holding paper claims when the exchange can no longer deliver what it promised. On January 1st, 2026, the Chinese government implemented something that fundamentally changed the global silver market overnight. They introduced strict new export licensing requirements for refined silver, effectively ring-fencing 60 to 70% of the world's refined silver supply for domestic use only. Think about what that means for a moment. The world's largest refiner of silver just told international buyers they can no longer count on accessing the majority of global production. This wasn't a gradual policy shift or minor regulatory adjustment. This was Beijing slamming a door shut on the global supply chain. The immediate impact showed up in Shanghai physical premiums, which exploded to $8 per ounce above COMEX prices. That might not sound dramatic until you realize what it represents. When physical buyers in China are willing to pay $8 more than the global benchmark price, they're sending an unmistakable signal that they cannot get metal through normal channels. They're bidding up the price of whatever remains available inside their market because they know the tap has been turned off from the outside world. But here's where this gets personal for traders who thought they understood how commodity markets work. In Rajkot, India, one of the world's major silver trading hubs, 44 trading firms officially declared insolvency in early January. We're talking about losses totaling $425 million. These weren't amateur speculators gambling with borrowed money. These were established trading houses that had been operating for decades. They were completely wiped out in a matter of days. What happened to them should serve as a wake-up call for anyone holding paper silver positions right now. These Indian firms had done what seemed like routine business in commodity trading. They sold silver they didn't physically possess yet, expecting to source it from their usual suppliers when delivery time came. It's called being short, and it's completely standard practice in futures markets. The problem was that when January arrived and their clients demanded delivery, the metal simply wasn't available. China had locked down exports. Premiums had exploded. And these firms found themselves in an impossible position. They had legal obligations to deliver silver that no longer existed in the accessible market at anywhere near the prices they had locked in. The destruction of these 44 firms tells you something crucial about what's happening right now in our own markets. When experienced traders with decades of relationships and supply chain knowledge get completely blindsided by a shortage this severe, it means the situation has moved beyond normal market volatility. These people understood how the silver market was supposed to work, and that knowledge became worthless overnight when the fundamental structure changed beneath their feet. Now let me show you something that didn't make headlines, but should concern every American watching financial markets. On December 26, 2025, the Federal Reserve injected $17 billion in emergency liquidity to an unnamed financial institution. The Fed's own data shows this clearly, but they won't tell you which bank needed the rescue. They just describe it as emergency lending to address unusual market conditions. What were those unusual market conditions? Silver volatility had exceeded Bitcoin's volatility. Let that sink in for a moment. A physical commodity that has been traded for thousands of years was experiencing wilder price swings than the most volatile cryptocurrency in existence. When the Federal Reserve quietly pumps $17 billion into the system the day after Christmas, they're not doing routine business. They're putting out a fire that threatened to spread. Some major institution had taken positions in silver that went catastrophically wrong when the market dynamics shifted. The fact that silver became more volatile than Bitcoin tells you how completely the normal rules broke down. Industrial commodities aren't supposed to behave like speculative digital assets, but that's exactly what happened when physical scarcity collided with excessive paper leverage. The data coming out of COMEX in early January reveals something even more alarming about trader psychology right now. Analysts examining open interest records discovered an unusual pattern that's never been seen before in silver markets. Contracts are being rolled backward. Instead of traders rolling their positions forward from January to March, which is the normal pattern, they're doing the opposite. They're moving contracts from March back to January and February. They're paying premiums to accelerate their delivery dates rather than extend them. Why would sophisticated traders pay extra to take delivery sooner rather than later? Because they no longer trust that metal will be available in the future. When you see backward rolling of contracts at this scale, it means the market has lost faith in the fundamental premise of futures trading that you can always roll your position forward and eventually get delivery when you want it. These traders are essentially saying they'd rather take whatever metal is available right now, even at a premium, than risk waiting until March, when the vaults might be completely empty. This connects directly to what's happening in industrial demand, and this is where the story becomes about more than just financial speculation. According to industry data, 60% of 2025 silver production was consumed by industrial applications. We're talking about AI hardware that requires silver for its conductivity properties. Solar panels that can't function without silver paste for their photovoltaic cells. Electric vehicles that use significantly more silver than traditional cars because of their complex electrical systems and battery management. These industrial users aren't speculating on price movements. They need physical silver to keep production lines running. When an auto manufacturer in Detroit needs silver for the electrical systems in their EV fleet, They can't accept a cash settlement from COMEX. They need actual metal delivered to their factory. And right now, those industrial buyers are competing with investors, governments, and financial institutions who are all simultaneously trying to get their hands on physical inventory. The Silver Institute projects that 2026 will mark the 6th consecutive year of supply deficits in the silver market. Think about what that means mathematically. For 6 straight years, the world has consumed more silver than miners produced. Where did the extra silver come from? It came from above-ground inventories, the stockpiles that existed from previous years. But those stockpiles aren't infinite, and we're now seeing what happens when they approach depletion. Analysts are forecasting another 100 to 200 million ounce deficit this year, and there's simply no remaining buffer inventory to make up the difference. Here's where Wall Street's credibility completely evaporated in 2025. At the beginning of last year, major investment banks were publishing research reports telling their clients that silver would average around $32 per ounce. They had complex models and sophisticated analysis explaining why silver would remain range-bound and why any price spikes would be temporary. Those same banks watched silver surge 147% over the course of the year, eventually touching $84 before the recent volatility. They weren't just slightly wrong. They were catastrophically, embarrassingly wrong in a way that destroyed their credibility on precious metals forecasting. But here's what you need to understand about why they got it so wrong. Those bank analysts were modeling silver as if the paper market would continue functioning normally. They assumed that supply and demand would balance through price discovery on futures exchanges. They built their models on decades of historical data showing that paper and physical prices stayed aligned. What they failed to anticipate was a scenario where the paper market itself breaks down, where physical buyers simply stop accepting paper prices as legitimate and start paying whatever premium is necessary to secure actual metal. The evidence is overwhelming that we've entered that scenario right now. Shanghai premiums at $8 over COMEX, Japanese dealers charging 40% premiums, Indian trading firms bankrupted because they couldn't source metal, the Fed injecting emergency liquidity as silver volatility surges, contracts being rolled backward as traders scramble for immediate delivery, industrial demand consuming 60% of production while we're facing a 6th straight year of deficits. And through it all, Wall Street banks maintain their models as if none of this fundamental disruption matters. What makes this particularly dangerous is that the American financial system is deeply exposed to silver through multiple channels. Our major banks have written derivatives contracts against silver. Our ETFs hold claims on silver stored in vaults that may not contain the metal investors think is there. Our industrial sector depends on reliable silver supply for critical manufacturing. When the pricing mechanism breaks and paper claims become disconnected from physical reality, all of these exposures become potential vulnerabilities that could cascade through our financial system. The backward rolling of contracts isn't just a technical curiosity for commodity traders to analyze. It's a red flag signaling that market participants have lost confidence in the fundamental structure. When traders who understand these markets intimately decide they can't trust delivery promises 2 months out, that tells you something has fundamentally broken. The machinery that is supposed to ensure orderly delivery and settlement is grinding to a halt under the weight of excessive paper claims and insufficient physical inventory. So we're watching in real time as the gap between paper promises and physical reality continues to widen. The Chinese export restrictions guarantee that Western markets can't access the majority of global refined supply. The destruction of Indian trading firms demonstrated what happens to anyone caught short when delivery becomes impossible. The Fed's emergency injection revealed that major institutions are already facing distress from silver positions. And the backward rolling of contracts shows that even sophisticated traders no longer believe the system will function normally in the coming months. All of this evidence points toward the same conclusion, and that conclusion should concern every American with exposure to silver through any channel. Let me walk you through the mathematics that makes what's coming next absolutely inevitable. COMEX has 127 million ounces of registered silver sitting in its vaults right now. That's the metal actually available for delivery against futures contracts. Meanwhile, China just locked down 65% of global refined silver supply behind export restrictions. So we're starting with a severely constrained inventory base that can no longer be replenished from the world's largest source. Now add accelerating delivery demands that are already showing up in January, which is supposed to be a quiet month. The math here isn't complicated. It's just uncomfortable for anyone who owns paper claims. When contract holders demand physical delivery at the volumes we're already seeing, COMEX faces 2 choices, and neither one preserves the current system. Choice 1, declare cash settlement. This means telling people who bought contracts expecting to receive silver that they're getting dollars instead. It's the exchange admitting the pool is empty. They can't deliver what they promised, so they're forcing you to accept currency in place of the commodity you contracted for. Choice 2, Let physical prices explode to $120 to $150 per ounce or higher. At those prices, enough holders will choose to sell rather than take delivery, and the remaining supply gets rationed to whoever is willing to pay the premium. Think about what both of those outcomes mean for the credibility of paper markets. If COMEX declares cash settlement, they're confirming that 356 paper claims per physical ounce was never a sustainable structure. They're admitting that most people holding silver contracts were essentially holding IOUs that can't be honored. The exchange survives, but trust in commodity futures takes a catastrophic hit. Why would anyone trade paper claims after watching the largest silver exchange in the world tell thousands of contract holders they can't have the metal they paid for? But if COMEX instead lets physical prices run to $120 or $150, while paper prices remain stuck at $92, that's almost worse for market confidence. You would have a situation where the official exchange price has become completely divorced from the actual cost of acquiring metal. It would prove beyond any doubt that paper silver is a fiction, a derivative that trades based on sentiment and leverage rather than actual supply and demand for the physical commodity. Either way, the current system doesn't survive what's coming. Now let's talk about JP Morgan's behavior, because when you understand what they're doing, you understand exactly where this is headed. For years, JP Morgan has been one of the dominant players in silver markets. They've held massive short positions. They've been accused of manipulating prices. They've been fined by regulators for spoofing and market manipulation. This is not a bank that operates from ignorance about how silver markets function. So when JP Morgan suddenly flips from being short to aggressively taking delivery of physical metal, not just participating in delivery, but delivering 99% of metal on critical days, that strategic reversal tells you everything you need to know about what the smart money sees coming. JP Morgan isn't panicking. They're positioning. They understand that when COMEX can no longer deliver and is forced to implement cash settlement, the 356 to 1 leverage ratio collapses instantly. At that moment, physical-only pricing takes over globally. There's no more arbitrage between paper and physical markets because the paper market has officially failed. Anyone holding actual bars can name their price because buyers no longer have the option of acquiring silver through exchange contracts. This is why JP Morgan has been working so hard to get physical metal into the possession of their most important clients. They're protecting relationships and securing supply before the door slams shut completely. When that flip happens, when COMEX forces cash settlement because they can't deliver, it triggers a chain reaction across global commodity markets. Every silver ETF suddenly faces questions about whether they actually hold the physical metal they claim to hold in their prospectuses. Every mining company's forward sale contracts come under scrutiny because nobody believes they can deliver into a market where physical supply has effectively disappeared from public exchanges. Every industrial buyer panics because their supply chains depended on the ability to source metal through normal market channels that no longer function. The February through March 2026 delivery periods are going to be the flashpoint where all of this comes to a head. Open interest remains at record levels, meaning a huge number of contracts are still outstanding that could demand delivery. But registered inventory continues draining with every passing week. We've already seen backward rolling of contracts as traders try to take delivery sooner rather than later. We've seen JP Morgan delivering massive quantities during what should be a quiet month. These are all symptoms of a system approaching its breaking point. Here's what happens to individual contract holders during those delivery months. You're going to face a choice, and it's not going to be a comfortable one. Option A, accept cash settlement when COMEX tells you they can't deliver the silver you contracted for. You get dollars at the paper price, maybe 92 or 95 or whatever the screen shows that day, but you don't get the metal you expected, and you miss out entirely if physical prices surge afterward. Option B, try to secure actual physical bars in the shrinking available market. This means paying premiums that could reach $120 or more per ounce. You get the silver, but you pay a massive premium over what you thought you'd pay when you bought the contract. Neither option is what you signed up for when you invested in silver. You expected that paper claims and physical metal were essentially interchangeable, that you could hold the contract for convenience and convert to physical whenever you wanted at roughly the same price. That assumption is being destroyed right now by the mathematical reality of insufficient supply meeting excessive claims. For Americans watching their retirement accounts or investment portfolios, this matters even if you don't directly own silver futures contracts. Many popular ETFs hold silver or have exposure to silver mining companies. Your 401k might include commodity funds that own silver futures. Your brokerage account might hold shares in companies that depend on silver supply for their manufacturing. When the pricing mechanism breaks this severely, the disruption ripples through our entire financial system in ways that are hard to predict, but impossible to ignore. The industrial implications extend beyond just financial markets. Our domestic manufacturing sector depends on reliable silver supply for everything from electronics production to medical equipment to defense systems. When the global market structure breaks down and physical supply becomes uncertain, it creates production bottlenecks that affect American jobs and economic output. This isn't just about traders and speculators. This is about the real economy where actual products get made and real Americans earn their living. What makes this situation particularly challenging is that there's no obvious fix available in the near term. You can't instantly create more silver supply. Mining operations take years to expand. The Chinese export restrictions aren't getting lifted tomorrow. The industrial demand from AI and solar and EVs isn't going away. If anything, it's accelerating. And the paper claims that have already been written, CA ain't be unwound without either massive cash settlements or accepting that physical prices need to rise dramatically to clear the market. So here we are in mid-January 2026 with all the pieces in place for a historic market dislocation. We have mathematical impossibility built into the structure. 127 million ounces, trying to back 356 claims per ounce, while China controls 65% of supply. We have smart money positioning, JP Morgan aggressively taking delivery while traders roll contracts backward. We have systemic stress signals, Fed emergency liquidity injections, and volatility exceeding Bitcoin. And we have accelerating delivery demands during what should be the slow season. The timeline for the breaking point appears to be the February-March delivery periods. That's when open interest needs to be settled. That's when contract holders either get their metal or get told the exchange can't deliver. That's when we find out whether COMEX forces cash settlement or lets physical prices explode to ration the remaining supply. Either outcome represents the end of paper silver markets as we've known them for decades. For anyone holding paper claims right now, the message should be clear. The system you're depending on is exhibiting every sign of approaching failure. The evidence isn't subtle. It's overwhelming and getting more obvious by the day. You need to understand your actual position. Do you own physical metal you can touch? Do you own paper contracts that might settle in cash when delivery time comes? Do you own ETF shares that represent claims on silver stored in vaults you've never seen? Each of those positions faces different risks as this situation unfolds. The time for paper illusions is over. We're entering a phase where physical possession is the only position that provides certainty. Everything else is some form of counterparty risk, a bet that when you want to convert your claim into actual metal, someone will be there to deliver it at a reasonable price. The evidence from Shanghai premiums, Japanese dealer markups, Indian trading firm bankruptcies, and COMEX delivery patterns all says the same thing. That bet is becoming increasingly dangerous. This isn't about fear or panic. This is about understanding the mathematical reality of what happens when a market structure built on leverage and paper claims encounters hard physical limits. The silver market is teaching us a lesson that applies to many areas of our financial system. When the gap between paper claims and physical reality grows too large, eventually physics wins. You can't deliver metal that doesn't exist. You can't satisfy 356 claims with 1 ounce. At some point, the fiction ends and the math takes over. We're watching that moment arrive in real time. And the implications extend far beyond just the silver market into questions about how our entire commodity trading system functions, and whether the prices we see on screens actually represent the cost of acquiring physical goods. The great delivery failure isn't just a silver story, it's a stress test of the whole architecture of modern commodity markets, and the results of that test should concern every American who depends on those markets functioning properly.